Hello everyone. We're going to discuss the upcoming new fund offer, the JM Large and Mid Cap Fund. The NFO starts on July 4th and concludes on July 18, 2025. We're joined by Mr. Asit Bhandarkar, who is a Senior Fund Manager Equity and would be the fund manager for this fund. We also have Mr. Deepak Gupta, who is a Senior Fund Manager Equity and would be the co-manager for this fund. It's a pleasure to have all of you with us. Let's dive in. So Asit, what are the drivers that you see for growth in the large cap segment, and what are the drivers that you see for the mid cap segment?
The drivers are essentially that we see for the country as a whole, all the equities. Particularly if you see, we have a young population, so India is going to be a great consumption story for the next few years. We are a very vibrant and well diversified sectorally in terms of our GDP makeup, and also now I guess from a largely service economy, we are now on the verge of probably becoming a manufacturing setup which can service the rest of the world. So these are the opportunities that are there, irrespective of which stock or which gap of segment of the market that you're looking at. That said, when we look at large caps particularly, what we see is there are mature businesses, some which have moderate growth, some which have low growth, and some which continue to grow quite well. But when we look at the mid cap side, we do see extremely high growth businesses where the growth path has been well established, where the risks to growth are less, and the organizations are at a point where the kind of risks that you have of execution on the small caps, perhaps they are missing. So when we look at a combination, what we get is large stable businesses with predictable growth trajectories in the large cap segment, and with the energy and the high growth of the mid caps. Put together, it's a quite robust combination.
Why should an investor invest in the large and mid cap fund? Why are you calling it a basic offering, something which should be part of every investor's portfolio?
So basically, large and mid cap comprises about 250 companies as per AMFI classification. Now, if you look at it in terms of numbers, that's just about 5% of the listed market universe. There are about 5,600 odd companies in the listed market. These are market leaders in the segments or the sub-segments in which they operate. But most importantly, I want to highlight something for you, that these companies comprises almost about 80 to 85% of the total market cap in the listed space. And the interesting anecdote is that this is roughly about 93% of the consolidated profits of the listed entities, and which is why, and this is a broad purview of about 250 odd companies, which is why we think this is a core product offering for any investor that one should have in their portfolio.
The large and mid cap fund, like you were mentioning, covers 250 companies that becomes investable universe. So it has a broad mandate. How do you think is this category different from other categories which have a broad mandate, such as flexi cap or multi?
By the nomenclature, large and mid cap fund have to invest minimum 35% in the large cap names and another 35% in the mid cap names. Hence, there is a meaningful component of large caps in the portfolio, which basically helps this portfolio to reduce its volatility meaningfully. And we have empirical evidence, and we have backtested the portfolios to see that most large and mid cap funds have volatility similar to that of a large cap, which a multi cap or a flexi cap portfolio will not have. They could have higher volatility compared to a large and mid cap. So at times during drawdowns, large and mid cap could outperform flexi cap and multi cap portfolios. Hence the risk reward in large and mid cap on an adjusted basis could be higher than a flexi cap or a multi cap fund.
Now let's talk a bit about the portfolio construction for the upcoming fund. So what are the broad guidelines on which the portfolio will be constructed?
Well, from a portfolio construction and stock selection perspective, We are a growth biased fund house. We do play in the high growth segment. So that is the broad construct or the background on which our portfolio will be constructed. Of course, playing growth has its own risks. There can be times of volatility, there can be times where things can go wrong or growth expectations can reverse, and that can have very serious impact on stock prices. So we have a quality overlay in that sense, where we try and make sure that the kind of companies we pick have very high cash flow expectations on their bottom line for us. We have reasonably high ROE, ROC expectations, and also I think we have debt averse. I think combination of growth with quality does that will be sort of the broad construct of the portfolio. This is the whole construct for the fund house as well, and I guess that will be the construct that will follow for this particular fund as well.
When you're talking about growth in earnings, how do valuations fit into the entire picture? What are other parameters that you consider? For instance, how does corporate governance fit in and all of those things? What is the overall process?
I think that's an important point that you touched upon. Because see, I think as far as corporate governance is concerned, we cannot be lax at all. So that's completely non-negotiable. We expect the highest corporate governance standards from each of the companies that we hold. On valuations itself, it's a little complex topic, because yes, sometimes growth companies can have extremely high valuations, and in recent times we've also seen growth without profitability. And yes, one part is that we do look at cash flows, and operating cash flows is an important parameter, which probably gives us courage to buy some of the companies which may not be profitable at the bottom line. But I think the bigger point is how much do you pay for growth, right? And I think there is no one answer for it, because see, we use ratios like the PEG ratio, etc., which sort of help us calibrate. Because see, the whole the growth segment works in such a way that there are companies which are growing at 10, 12, 15%, which is quite good growth. But also there are companies which may be at the early stage of their growth, or maybe disrupting some large business, and then you are growing at 50, 60% also. Now, how do you value them? Of course, the companies which are growing at 10, 12% may be valued differently, and companies which are growing at 50%, 60%, 100% may be valued differently, right? So when we look at some of these companies, of course we look at cash flow, but we also look at what is the multiple that we are paying these companies, and we are sort of we are okay to pay more for growth, but we want there has to be sufficient growth for the PE that we are paying. So, for example, if company is growing at say 35%, I may be willing to pay say a higher PE for that than a company which is growing at 15 PE. So we calibrate our portfolio choices accordingly. Of course, there are times when market expectations of growth become just too high, and the valuation is too high, and typically at a particular multiple of the PEG ratio, we do exit this stock. So it's not that we will not exit stocks which are high growth at every price. There are prices where we will say no longer can we participate at this price.
So we understand that we are primarily growth investors, and we are willing to pay a price for growth, but we are going to calibrate our positions in the portfolio based on the growth potential for different stocks. So for the large and mid-cap fund, we understand that the growth kicker is primarily going to come from mid-cap stocks. But so how do you manage to provide for the inherent volatility of mid-cap stocks? How do you intend to manage the risk aspect of it?
Volatility is the name of the game in mid-cap names, and hence one has to be extremely measured when one selects these mid-cap stocks. We basically run weekly performance attribution to see how the mid-cap portfolios and the large-cap names are doing, and wherever we feel that the risk reward is not in our favor, we will prefer to withdraw rather than stay invested. We are extremely focused that we look at returns on a risk-adjusted basis, and the risk reward has to be in our favor, and that is how we intend to manage the volatility in mid-cap names.
Asit, what do you think will be the parameters based on which allocation between large cap and mid cap segment will be determined in the upcoming fund?
Wow, you want the secret sauce. I'm not giving it here. I'll tell you very frankly, it will depend on relative attractiveness of the valuation and the opportunities and the choices provided by the market at any given point of time. Right? So, of course, as we've discussed, there is a minimum requirement of having 35% in each of these caps. Where will the rest 30% go? We'll decide closer to the date. My guess is, being growth investors, it is a possibility that there might be a higher mid and small tilt to the portfolio. But that said, we will be very conscious about the risk and the volatility. And if at the time of the and this portfolio is going to be out there for all the time, right? So there will be points of time where the large caps will be at a very higher level than the minimum required to bring the essential stability to the portfolio.
Is there any sectoral tilt or theme that you are currently favoring or are consciously avoiding at the moment?
So as on date, a sector where we're extremely positive currently is towards rate sensitive sector. As you would be well acquainted with, RBI has become quite benevolent in the last 6 months, and we have seen that the inflation has started tapering off, and we are right now sub 4%, which is extremely sanguine for rate sensitive sectors. We've had a rate cut of almost about 75 basis points in the last 6 months, and we think that rate cuts cycle is going to be elongated, and hence we are more positive towards rate sensitive sectors, be it consumer discretionary, which includes autos and high-end consumer discretionary, along with financials as well as names in real estate space. We are cautious on consumer staples, particularly given the fact that the moats that these businesses had developed have got disturbed with increasing salience of D2C brands. Hence, we are running a bit underweight on that sector, as well as oil and gas sector, where we are seeing challenges given the volatility in crude oil prices and difficult to predict where commodity prices will land given the volatility that is taking place in the global scenario, and hence we are circumspect on that sector as well.
Right. So we understand a bit about how the portfolio is likely to be structured. But now let's come to the broader markets in general. So we've seen considerable amount of volatility in the very near past. However, as we speak, there are green shoots which are emerging. So the FPI flow reversal is a nascent phenomenon which we are all observing. Market breadth is increasing. So do you think this is a reversal of fortune of sorts for the Indian markets?
Well, you answered a lot of the question, a lot of what I could have said in your question itself. Yes, I think on the global side, what's clearly happened is that FIIs are looking to diversify, and this is not just the India theme actually. If you see, FII investments are going up all across the world, ex of US. So money is sort of flowing out of the US geography and getting into other geographies. If we actually see, most of the markets, even in the European region, have done phenomenally well. We have seen emerging markets also benefit meaningfully. So it's not just an India specific thing, it seems like a global, durable diversification thing that we are sort of benefiting out of. As far as local things are concerned, I guess, say in 2024, things did look a little overextended. There was a bit of euphoria. Yes, I think the domestic sentiment, investor sentiment, not the corporate sentiment, investor sentiment may not be where it was last year, but I guess that's good. And that said, the mutual fund flows continue to be positive, may not be at that level as it was last year. So overall, from a technical perspective, the market looks to be on a very strong feet right now. There can be discussion about valuations, what they should be, but in the overall construct, the way our economy is right now, the way where rates are, the fact that markets probably are lower today than they were about a year back, I think all this puts us in a very comfortable position as far as the equity markets are concerned. That said, this is a risky product. Equities are a risky asset class. Volatility is part of the game, but in the backdrop of corporate earnings improving, interest rates coming off, liquidity improving, FIs returning to the market, I think things look much more stable right now.
If there is one thing that you want investors to retain from this conversation about the JM Large and Mid Cap Fund, what would that be?
So, in my view, one should look at the JM Large and Mid Cap Fund as a proxy to invest in the growth story of India, given the fact that it addresses almost about 93% of the total corporate earnings. And one should not look to time the market, given the fact that on a short-term basis markets have done well, and while markets are not looking cheap, they are definitely not very expensive as well. And one should look at returns from a 3 to 5 year perspective.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.